welcome back to our video for today. So today we'll be going to learn an adjustments for our non-current asset called depreciation. So if you still remember, non-current asset will be our asset that we're going to use for a long-term period of time. For example, we have our furnitures, we have our fixtures and fittings such as our aircon, our office equipment such as our PC, and our motor vehicles such as our car, van, lorry, motorcycle, and etc. So a depreciation is a condition where our non-current assets gets older every year. Meaning, for example, our computer. During the first few years, it works fine. During the 4th, 5th, 6th, or almost towards the 7th year, your computer starts to lag, start to have many problems on startup issues, screen issues, and lots of issues happening. So that will mean that your non-current asset is getting older and older every year. So its value lost as time goes by. So slowly, yet so fast. So we can say the lifespan of the asset is decreasing. So depreciation is an estimate of loss in its value over a period of its working life. Sometimes they use it as useful life. And the accounting treatment has to be followed with the matching concept, being prudent, and depreciation has multiple formulas. Once our company decides to adopt one of the formula, you have to be consistent all the time. So consistency plays a role here. You have to be consistent because once you change your accounting policy for its depreciation formula, things will be a little bit, troublesome. In terms of the reporting wise, you have to explain into the notes of financial statements and the numbers may not be really, matching. So it is best if you use straight line method for motor vehicle, you have to use it like almost for every year, almost forever. If you really want to change, well, there's a rules to apply. That will be in your IAS number 8 accounting policies. So international accounting standards, the standard will teach you how to change things. Okay, so there will be meetings to attend to and discussion will be done. Yeah, so to avoid these trouble things, you have to be consistent. When you use one formula, use it, best is almost forever. Okay, now, so how is the accounting treatment? So the first formula that we always hear is the straight line method, whereby the depreciation value every year is the same. Normally they call it at cost. So our accounting period, let's take it as January to December basis. Okay, so it's the year 2025. Okay, we bought a van, our motor vehicle, costing 10,000 by check. And then our policy of depreciation will be 10% at cost. We buy it during the January. Okay, so I will normally do this. There will be a year, 2025. Over here will be my workings. And then depreciation amount. And the accumulated depreciation. Now, in your syllabus, they will use the term provision of depreciation for whichever asset. Regardless, in your income statement, by right, you should put depreciation, but they still only use provision for depreciation. In your SOFP, instead we use accumulated depreciation, but it's also referring to our provision for depreciation. So it's a little bit weird here for your syllabus right now at the moment. Until you go to your university level, then it will have separate ones. Okay, the terms will be different. This is what we're using all the time in IGCSE. So the workings will be as such. 10,000, the cost multiplied by 10% because at cost. So the cost of the van is 10,000. So it will be depreciation for the year is $1,000. So meaning to say this year, our asset, since this motor vehicle will be accompanying us from the month of January up to December, so it starts to depreciate its value. It starts to vomit blood. Every year as I service for you, I vomit blood. Or I get older by 1,000. It's like this 10,000, the cost is like your life points. Every year it will be loss of 1,000 life points until it reaches 0. So 10%, if you look at it, every year, 10% will reduce. So meaning this particular van, we are expecting a life of 10 years. Okay? So that's what it means. So accumulated depreciation means how much it has lost blood. So the total of its depreciate amount. So the first year's depreciation will be always the first year's accumulated depreciation because it's very new. Okay? And then during 2026, it will be also the same thing, but the accumulated depreciation will increase by another 1,000. And hence the following all the years to come. Okay? So how will it be the accounting entry, the double entry particularly, very simple. It is always the case, debit your income statement. Okay, we use this debit income statement, and then we credit the provision for depreciation. This is the one we use all the time. Okay, debit the income statement under the expenses heading. We write them as provision for depreciation. Let me check. Provision of depreciation. A provision for depreciation of motor vehicle. Okay, this is the double entry all the time. Very simple. Okay, so let me show you the income statement. Okay, income statement for the year ended 31st December. Okay, let me give you for the multiple years. Okay, 2027, 2026, 2025. Okay, under the expense heading, we have provision for depreciation of motor vehicle. Every year will be the same. Okay, let's make it negative because under the expense column there, we will be minusing them. And for the SOFP, as at 31st December of every of this year, it will be like this, yeah. Okay, well, all in dollars too. Okay, we will have NCA over here. You'll be writing the motor vehicle, the cost. Okay, 10,000, 10,000, 10,000. And then you have to minus the accumulated depreciation. We're going to write this here. We're not going to write provision for depreciation because the SOFP statement formula on the center there, you write them as accumulated depreciation instead of a provision for depreciation. Well, that's the bigger part, as I mentioned earlier. Okay, so during 2025 is 1,000. 2026, the total is 2,000. 2027, 3,000. So 2025, it will have balance of 9,000 of net book value, we call it. Net book value is the cost minus accumulated depreciation of the asset, the balance. Okay, sometimes they call it as a carrying value or carrying amount. 2026, it will have a carrying amount of 8,000. 2037, it will be left with 7,000 net book value. It's like how much blood left for that particular asset, its life. Okay, how much life it has left. Every year, it will reduce by 1,000, 1,000, 1,000, 1,000. That's how it is. Okay, so this is straight line method. Then, the second one, the common one that we see is the reducing balance method, or sometimes they call it as the net book value method, or sometimes they call it as also the diminishing value method. But most of the time, you'll be seeing it as reducing balance method. Okay, this means your amount of depreciation every year reduces. So let's change this time. Yeah, we buy a cupboard. Okay, then the cost of the cupboard, as in this is our furniture. We buy it on January as well. 20,000. Okay, maybe we buy 10 sets of them. So it's 20,000 on January by check. Okay, reducing balance method is our accounting policy. We're gonna use 10% again. Okay, so meaning this furniture has a life of like what? 10 years like that. Okay, every year reduced by 10%. So double entry will be again the same thing all the time. But the format will be like this. Okay, the year 2025. Okay, the depreciation amount and the accumulated depreciation. So 20,000 times 10% is 2,000. Okay, well, dollars though. Okay, so the first year's depreciation will be 2,000. Accumulated depreciation will be also the same, 2,000. Always the first year's depreciation is the same for its accumulated ones. Always remember that. Only during the second year, things change here, depending on which formula that you adopt, either at cost or reducing balance. In this case, reducing balance is like this. You have to take the cost minus accumulated depreciation of the previous year. Then you multiply with the percentage. Therefore, we have 20,000. You minus off the accumulated depreciation of last year, which is 2,000. And you multiply by 10%, and therefore you'll be getting 3,800. And accumulated depreciation will be, you just add up, that will give you a 3,800. And if let's say for 2027, then again 20,000 minus of last year's accumulated depreciation, which is 3,800, multiplied by 10,000. Okay, 1620, 5420, and goes on. Let me give you for 2028, 20,000 minus 5420 times 10%, 1458. So 6878 will be the accumulated depreciation. Then the ones that you record in the depreciation for the income statement portion will be this one. Okay, let me give you the SOFP, the income statement and SOFP ones. 2028, 2027, 2026, 2025. Expenses column here. Okay, provision for depreciation of, this is our furniture. 2028's one will be 1458, 2027 1620, 2008, and then 2000. This is how it looks like. Okay. Double entry will be the same. It is always based on this figure that you do the double entry. Your provision, the balance of your provision for depreciation is always a credit balance, same as your provision for doubtful debt. It is always a credit balance. So each time it will be updated, okay, with this amount. This is the figure every time. Okay, debit credit, the same amount with 1,000. But for reducing balance, depreciation, the first year is 2,000. So you do the debit credit. Okay, you credit your provision for depreciation with 2,000. You close, you bring to the next year 2,000, and then you add up with another credit of 1,008. Then it will become 3,000. Then after that, you do the same thing every year. So your credit balance of your provision will reflect the accumulated ones of the year. Okay, you can try to do it on your own. That is your homework. Okay, SOFP wise, 2028, 2027, 2026, 2025. So we have our non-current asset here, our furniture. The cost 20,000 minus accumulated depreciation. Okay, the first year will be 2,000. Then second year will be 3,800. Third year is 5420. The fourth year is 6878. So you calculate all of them one by one. Okay, so this is how we do the reducing balance method, right? So that's all for this part of the video for non-current assets adjustments on depreciation. The next one for non-current asset adjustment will be dealing with disposal. So I shall see you again for the next part video. Okay, bye.